All right, so question answer. We have the FCS Excel tool will accept formulas. The answer will probably be yes. Be careful on rounding. Really, it's a person who works for me, Craig Coxon, who's trying to do all this, and we're putting it together. I think my email's out there. If you have questions or you're looking for something specific in that Excel that you would like it to do, just send an email and I'll get it to Craig. He can probably get it to work. I can't. This is not me.
Yeah.
But the idea is, he was saying he was able to open up some tabs and have it linked to the templates and stuff. So I think there's going to be some latitude on what you can do in there if you want to use that tool. Who's got the clicker? Come on, Ray, this one's yours.
Oh, yeah, right.
You know, it's frustrating, isn't it? I mean, how many changes have we went through over the past few years? And giving it up to HUD, I mean, HUD converted to the GAAP basis, right, with the UFIRS rule, and every time they turn around and they name something, GASB comes along and what? Just scratches it off and redoes it. You know, to a point here, I think you're starting to see the emergence of some of the accounting rules going to the full accrual basis. I mean, it's frustrating, I know, but I think the premise is what? To at least get all of the financial statements, get them on the financials, see where they are, let's see the position. I think they're pretty close. I don't think there's much else that can be added.
I can't think of anything else they're going to add either, but I was at that conference and the GASB guy was saying that the GASB board's on track to try to put 2 to 3 GASBs out per year.
Yeah, I know
so
70 has been released.
Actually, on this thing also, I think the only thing that really I think gets at people is just the breaking out of the deferred inflows and outflows. You know, net position, that's a definitional kind of a thing that to me, CPAs get caught up, because we get caught with reports that say net, assets or whatever, and so we worry about that a lot. But truthfully, this is 6365 is a fairly small series of changes, really, that I think for PHA-related stuff, the deferred inflows and outflows end up being more of a discussion item than they are, until we get to pensions or something else, an impactful item for PHAs. But, let's be honest, the AICPA, the FASB, I mean, the GASB is just catching up to the FASB. I mean, we've been recording these liabilities in pension stuff for years. So they're slower because their user group is more resistant in the government to actually recording liabilities that taxpayers have to pay for. And it's taken really some time to get them to smell the roses or the coffee or whatever. So it's like the slow inexorable change. It just, we just get it. It's just going to happen no matter what. It'll never slow down. It just goes faster. Until you reach the speed of light and then everything stops anyway.
Maybe I can take a stab at this one. Let me just give you a little background here. On this UNA balance on the VMS, one would think that we would be rolling it. So in other words, just like we have on a financial statement for a balance sheet that you're issuing on a monthly basis, you would show your UNA rolling forward each month for any net change, typically. And I was served on an advisory group for the VMS working group, and we pretty much had the Financial Management Center convinced that it ought to just be a rolling balance. You're taking that net change and just rolling it each month so you have an idea what that is. But unfortunately, Office of General Counsel got involved, and then the whole thing just died. Because basically, Office of General Counsel said, no, The unrestricted net asset balance doesn't effectively change until the end of a calendar year, so therefore we cannot reflect the current net change in the balance.
Calendar year or fiscal year?
So basically what we're recording in there is your beginning balance plus any increases that are the result of fraud recovery and interest income, which even that doesn't make sense to me. And if you want to also, what I didn't point out earlier that might be helpful for some of our folks, especially if there's new PHA folks out there, you may want to go to the VMS user guide, and there is a new release of that out there, and there's a really handy appendix at the back of the guide that you can kind of quickly go through, and it'll give you the guidelines on what's supposed to go in each of these accounts. And so if you look at that, it says the monthly amount reported in the UNA balance at the beginning of the year plus any interest earned and fraud recovery allocated to the UNA account for the months in the current year. And then we don't reflect the net change overall until the end. That'd be your last month in your reporting period.
Right, so even that doesn't talk about net fixed assets.
No.
That's clear.
Yeah. Yeah. So anyway, that's kind of where we were. We thought we had got them convinced that, you know, it'd be easier for the PHAs if we just roll it forward, but Office of General Counsel got involved and that killed it.
Ron, now, I want to ask you particularly in your business, are you rolling them forward still just like he described?
Yeah, basically the one thing we are doing that is a little bit different from that is we are showing any net losses and we are decreasing our numbers. We will not show any net increase until the end of the fiscal year, and then we'll roll that net increase up into, so it'll tie with the FDS schedule.
And my perspective is this, for all practical purposes, I roll mine stuff forward monthly, and I just recalculate net assets, and we just make sure that they understand what the difference is. But my spreadsheets all track the net assets.
Yeah, so you're rolling it forward.
Yeah.
And, you know, the other thing that seemed to be inconsistent is that they said that if you happen to use UNA to cover HAP expense, then you would reflect that reduction. So you see, to roll it forward makes more sense than these half in, half out kind of entries. But we
Well,
never
and-
said there was a logical conclusion.
And their perspective is a legal one, because I
Yeah.
can't claim that you spent it until we get to the end of the year,
Yeah.
which I understand, but practically it's
Yeah,
gone.
and we said, yeah, we understand all that, but from a practical standpoint, what difference does it make?
The other thing I want to make sure of, auditors, let me just say this. All you have to do is remember this phrase, auditors. If VMS doesn't, if FDS doesn't equal VMS, then Chris has PMS. Or he's a pain in my ASS.
He just thought of that one.
No,
Yeah.
I've been saying that forever. Look, it's not in the compliance supplement, auditors, but I think one of the number one rejection issues right now is VMS does not equal FDS. So make sure you put that, I know it's not in the supplement, but if you don't do it, you are just waiting for pain to come, and you're going to go, I've got to resubmit it again, and I got to do this or that. Just make sure their numbers match.
But I still think you got to be careful a little bit from an audit side.
Only because now we got to back out what? Fixed assets.
Yeah.
But the numbers better be right there rolling
Just
forward
like
to
I
the
went
audit.
through earlier today, you know, those accounts, they need to be close to those amounts on the FDS that we talked about. Or you're going to get more and more, you know, conditional acceptances and ultimately rejections.
And we just don't want to deal with it, right? Because I want.
And the one other thing is that we haven't really said much about is by the time you get all that figured out, HUD may have an entirely new system. What's called the next generation management system. I'll probably be dead in the ground by then, but you never know.
Just be careful a little bit when you're looking at the VMS amounts. I mean, as part of our protocol, we go in, we grab the VMS data, we show it into an Excel spreadsheet, we're trying to match it up, understanding that the VMS numbers are used for what?
Funding.
The calculation of funding for the next year. So we went into an agency. Unfortunately, they misreported their HAP payments on VMS. They overstated their HAP payments. What does that mean? They got overfunded the next year. Material finding. It was a large
And
dollar
HUD
amount.
will come and they will take that money back. And unfortunately, if you undercalculate your HAP, there's no money to give you, because once they slam that door shut for the calculation of renewal funding, they must, by statutory requirements, divvy out that money. It has to be allocated and obligated. So there's nothing to give you.
Then we have an internal control issue.
Marlo.
Auditor does his due diligence in covering fraud considerations, well documented, but the nature of fraud is deceit. Will state boards, peer reviewers, others sue the CPA based on oversight? You know, I don't know. I mean, who knows what anybody in our litigious society would do? You know, I mean, anything's possible, I guess. To have carefully followed and documented the standards probably is a pretty good defense. Do these rules make us more susceptible? No, because they're highly judgmental. You know, my opinion versus your opinion as two professionals, that's just a contest between two liars, and nobody wins except the liars.
That's the point anyway.
Right. I don't, unless anyone else has some comments, that's about all I'd have to say about it. I mean, to me, the worst situation that now exists is not the fraud auditing standard, but it's abuse in the Yellow Book. The new the waste and abuse, the new definition of that in the 2011 Yellow Book, that to me is a far more nebulous concept to deal with and to determine whether or not an auditor will have exposure for, quote, deciding that some circumstance is not waste or abuse, and maybe it is waste and abuse. And that definition in the mind of lay people, you know, who knows where they're going to come at from that. I mean, look at what's happened in the last few weeks with this discovery of the IRS scandal about the parties and things. You know, was that waste and abuse? Will anything happen? You know, I mean, that, to me, that's a whole different concept that's more difficult to deal with than is fraud. Fraud, now in the literature for auditing and accounting, fraud has a specific definition, and it is very narrow. And anything outside that definition from our professional responsibilities would pretty much leave us off the hook. But the broad brush approach that's in the Yellow Book for 2011 is far more scary to me than is the fraud stuff.
You know, Marlo, and you mentioned that in December also, where we were doing multifamily. And I guess the question is this: you say that again reminded me of something. You know, you're out auditing and you see things that are borderline. I mean, let's be honest. You're saying to yourself, the guy needed an executive director, bought a truck. He wanted a truck. He needed a little F-150 for the maintenance guys to drive around, you know, or a little Ranger or something like 5 years old that's maybe just barely safety standards. But he bought a Duramax diesel, blah, 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 right? Now, we're all sitting here going, shaking your head. And I remember we went out to a housing authority once, right? You remember pulling into the parking lot. We were there early and the gates were closed. And there were over 25 or something Chevy, what were those little white cars? No, they were small. They were not that small. Anyway, and they were all sitting there all in the line. And they had decided that they would take capital fund money and buy these 25 cars for employees to drive out to the sites because they were afraid that their cars would be vandalized. Well, you know, if I'm the auditor, honestly now under what Marlo's bringing up, if that was brought up later to the press, would that be defined as abuse? And I think to most taxpayers, the answer would have been, heck, not only yes, but why the hell didn't it come up before yes?
But I would argue, Les, that, I mean, they have an annual plan and a 5-year plan. And those would have been in it, and somebody approved it.
Somebody approved.
So, you know, how can you then hold the housing authority as fraud and abuse when someone higher up said, yeah, it's okay to spend this money?
But see, here's my point. at some point, you've got questions that don't come up as clearly in the plan. You're better off to at least disclose information to oversight on issues where you come across this, you're going, I don't know whether this could be abuse. I might be as prone to include those discussions up about transactions that could be interpreted to be different than what you've interpreted them to be. I'm not calling them that, but I'm saying, as oversight people, would that be outside the realm of what I should be doing to help me cover myself? Some disclosure of the oversight that would say, hey, here's a couple of transactions that I don't know, but if I wondered what was going on, my standard says I probably need to bring this up to you a little bit to say you need to consider this sort of thing, what it would appear to be after the fact. I mean, I'm from Salt Lake, right? You get the Olympics, you got all these guys in government and CEOs handing out $20,000 Browning shotguns on the steps of the state capitol to representatives of the IOC. 2 years later, they're going, hey, you bought their vote. Well, it seemed like a good thing to do at the time, right? When the cold hard light of day shined a light on it, it was like, that probably was buying their vote. And that all the CEOs went back into their holes. I didn't know anything about that. I got a picture of you holding the shotgun as you smile and hand it over. So you never know. Sometimes disclosure at some level is a good heat shield. If I have to come back through reentry, something better be underneath my bottom before the atmosphere hits it. That's the only reason I do some of that.
The question is, should I be concerned in this last funding letter if they didn't show your program reserves? I don't think so at this point, because HUD's still trying to decide how that formal notification to you is going to occur for that program reserve. Clearly, you should track it so you know what it is, because that money is available to you for leasing. But at this point, I don't think it's a concern if they haven't shown what that is. You should know what it is. And it's, as we said earlier today, it's an easy calculation. It's whatever the amount of your ABA you didn't use last year in the calendar year is now sitting in that program reserve, and you know it's there. And if you need it, you just contact your financial analyst at HUD and show a need, and they will facilitate getting out those funds dispersed to you.
And as a starting point, what we have used is HUD sent out the fourth quarter disbursement schedule, their Excel spreadsheet, where they calculated the amounts. There on the bottom of it, they listed the undispersed funds from the 2012 year. So it'll at least kind of give you a number at the end of December 31st. It's not absolute, but it's a good number to start with. That Excel spreadsheet came out the week between the 24th through the 27th of September, somewhere in that time frame. It's an Excel spreadsheet. Okay,
Next question is, people are asking, what should we budget in terms of public housing and Section 8 in terms of the proration? It looks like the overall proration for public housing operating subsidies are going to be somewhere around 82%. The department, until they knew what the appropriation was in January and February, they paid us at 92% of eligibility. They now calculate in order to get it at the average 82%, they're probably going to have to pay it the rest of the year at 79%. So the bottom line is, for budget purposes, the target is about 82% of eligibility on public housing op sub, and then on Section 8, we said the HAP side is around 94%. And on your admin side, it's at 69%.
Any idea what to do for 2014?
Good question. I would say from going forward as a conservative stance, I would probably use the same proration factors. I don't know that they would be significantly less, but I think you'd be conservative in saying, okay, we're going to assume 82% operating subsidy eligibility, 95% HAP eligibility, admin, 69, 70%, just to be safe. And maybe run what I would suggest is running some scenarios, especially on that admin. What is my break-even level? What do I have to what do I need, Because the bottom line, if you need 85% and you're only at 69, You either got to figure out another source of funding to influx into that program, or you're going to have to cut the biggest expenditure, which is salary and benefits. I mean, that's the bottom line.
And I would really recommend to run different scenarios exactly so you can have some plan of actions. What happens if this is the funding level? What's going to be our approach?
The short for the HAP side, and there is some ability for the set-aside funding, you know.
Okay, CFP equity transfers. I'm assuming we're talking about the equity portion of the CFP program that's transferred over to the operating fund program. HUD basically, from REACT's perspective, they defined it that when the asset is placed into service, it should be transferred at that time. Now, I kind of look at it and say, well, that's great, but sorry. We wait till the CFP is indeed closed, and then we transfer the equity portion of that closed CFP into the public housing program. We still record depreciation when the asset was placed into service. That does not differ, so we're just recording the depreciation expense on the CFP side. It doesn't matter, it's not changing your balance sheet from that approach, but from our accounting systems, we're trying to have a clean capital fund report. Let's get it closed. Let's get it to the point it can be audited. Let's transfer the equity at that time.
And then remember, from REACT, it's really difficult to see because it's one balance sheet. So we can't really differentiate. I mean, you have to be really looking for anything to figure that out.
I guess I'm assuming this probably came from maybe an audit or some other regulatory agencies that might be involved with PHAs. I mean, there could be, you know, any number of others. I remember in some days, some PHAs had some special grants from the Department of Justice. There could be, as you know, many state grant programs that they're getting that have to be follow state laws.
Agriculture.
Could be agriculture. We see a fair number of PHAs that are administering some farmers home loan kind of stuff.
I think
What other?
some states have special procurement rules that all governments must follow. Open Meetings Act rules that all governments must follow. And I think the biggest one here that we always have to worry about, OMB. OMB
Yeah.
circulars, right? They're going to trump HUD. Yeah, you end
Yeah.
up with bond issues, some of those. There's all types of issues to look at.
Well, I mean, tax credits would bring the IRS into.
Yeah, IRS rules.
And the IRS rules are involved anyway, right? I mean, we got to worry about, are they following some of those regs?
Yeah.
And I'm
And another one would be under IRS, and this is what Ron and I have been talking about. I don't know how many of you have been seeing, but the IRS now is focusing on housing authorities over the last couple of years, and they have been auditing PHAs to take a look at, are they classifying compensation to employees correctly? And they're looking at things like, you know, car allowances, all these different things that we give employees as benefits, and are they being classified correctly? We've seen one large housing authority in our San Diego area had an audit. Several of them up north of us have had audits by the IRS. Ron's experienced some clients with IRS audits. So again, you know, that's all that payroll and classification, you know, properly of compensation.
And don't forget the Department of Labor now with, you know, with pensions looming. Don't forget them. And you mentioned this IRS audit about are you an employee or being treated as an independent contractor? I had one of my clients, IRS came in and it was a city, and they had one employee who was the clerk of the court, the municipal court for the judge, but at night she did the custodial service of the building, and they were giving her a W-2 for being the clerk of the court and a 1099 for being sweeping the floors at night, and the IRS said no, it's all W-2, and made them reclassify the quote payments that were done under the 1099 back as wages, grossed it up, and nailed them with the penalty and interest for the
And
payroll taxes.
Yeah. Yeah, we, in California, where we come from, we have some very, very stringent whole set of criteria that you have to go through, which is not uncommon in a lot of states, of how do you define an independent contractor? And so you're always having to meet the stricter of the two. What does the state say versus what do the feds say in terms of what is considered an independent contractor? And boy, they're always looking to break that veil, because if they break that veil, then of course they're getting more payroll taxes and so forth.
Ray, one more comment, tax credit stuff. We talked about tax credits last year. I can't overemphasize that enough. I hear a lot of people tell me, oh, I got these tax credit audits. They go, oh, those are easy. Those are like sleepwalking through the audit. I'm going, well, those regulations not met cause recapture. This is not a sleepwalk issue. So again, I think this question comes up from Marlo's comment yesterday about regulations and what was it, AU 250, wasn't it, Marlo? Look, on tax credits, I don't know that you can overemphasize that either, because
Yeah.
those audits are not just some freebie thing. They have big impact if you fail. Because who's going to bear the brunt of that problem if credits are recaptured?
Yeah.
It's the housing authority. So again, don't ignore those issues. I know people say, oh, that's an easy audit. I'm going, well, you know, outside of 10 issues.
And there's all kinds of file documentation issues on tax credit. I mean, yeah.
Okay.
Just a minute.
Okay.
You were mentioning issues with the IRS and some of the housing authorities. Some of the EDs receive allowances for mileage and phone on a monthly basis. Is that gonna create also, that creates IRS issues, right? Whenever they're
Yeah,
on,
really what the IRS looks at in any time I've seen them do the audits is they look at any kind of payment like that to an employee, and what they're looking for is, okay, tell me, do they ever use that for personal use? And if you answer yes to that question, they better see a portion of that being treated as included in wages. And that's what they'll look for. And it's going to be really difficult to convince the IRS that you've given someone a cell phone allowance and that some portion of it, let's say you're paying the whole cell phone bill for them, that there aren't personal calls being made on that cell phone. You've given them a car that they're driving home and using, because the time to and from work is not considered a business activity. It's only once you're at work and then you go to another place of business that's considered the business sort of expense. So they're going to look for all that kind of stuff, and that's indeed what they do.
There's a federal, state, local government guide, employee benefit guide, that was just released, I think, in January of 2018. It's about 90 pages.
Yeah, it's a thick thing.
And it gives you lots of examples of travel allowances, car allowances, travel, use of the personal equipment. Take a look at that. Go to the IRS website, and this federal, state, and local government division is what it is. And they just got a whole new guide out there. Matter of fact, 2 weeks ago, they just had a telephone webcast of some additional training on that. So if you look at their websites, you'll get some training sessions on these issues.
hey, I think there's something, I'm not a real good tax guy, but I think for cell phones, I think there's something out there about cell phones that you can use cell phones for personal use. You don't have to allocate personal use for cell phones, but
Yeah, back in 2011,
Yeah.
there was a revenue ruling that basically said it was de minimis and skip it and don't worry about the cell phone use.
right. But vehicles and other things like that.
Vehicles, definitely, yeah. Who's got the clicker? Sorry. Oh, we haven't done it, sorry.
Oh, yeah, it's me, huh? You know, these are always kind of interesting from a GAAP perspective here. We're talking about small purchases, but maybe part of a larger project here. You really have to take a look at and say, is this routine maintenance? Does this meet the definition of an asset, or do we really think this is an expense? Oh, put it in my pocket. Okay, better. And, you know, so when you replace a hot water heater, and you're just replacing one. Is that a soft cost or hard cost? You come back and say, well, that's about $600, that's going to be a soft cost. But I replace every hot water heater in a 400 unit property. So now you're looking at a $250,000 contract to replace them all at one time. And so I'm looking at the definition, trying to say, does this indeed extend the life of the asset of the project, or is this really ordinary maintenance cost? So if I'm going to come in and have all 400 of them replaced, I think, you know what, I'm going to get 10 more years out of this cost. That's a cost I'm going to depreciate over time. But if I'm just doing one at a time, two at a time, for the sole purpose of replacing it for maintenance, then I come back and say, no, that's an expense.
So if you replace all the locks on all the doors,
I think you've always got to use judgment call. How much is it? And this, you know, this is, it's not a black or white area, right? I mean, it's not absolute this way, that way. You got to make judgment calls on that and how much it costs and the dollar amounts and things of that nature. Yeah, and if it is a huge cost and you're going to get 10 or 15 years benefit out of that, then I would go ahead and capitalize it. You know, a lot of times what I'll come back and say is, and you do draw the line. I mean, it's not going to help your cash position. I mean, they're trying to help their profit and loss side,
Yeah.
but their balance sheet is still going to deteriorate between the amount of resources available. I would say, and shoot an email off to the auditor.
Ron, you know, there's some changes coming out that they keep delaying, having to do with capitalization of purchases. Tax stuff, IRS stuff. Is that going to impact some of this stuff?
It could.
I mean, only for guidelines, but yeah.
I mean, I still think, even from those regs, we still have to follow the cap policy. Now, we may fine-tune that policy a little bit, right? And I've seen a lot of agencies fine-tune those cap policies. We're going to capitalize everything of a cost of $2,000 or higher, except for ranges and refrigerators, and we're going to capitalize them no matter what the cost.
I had no idea.
Well, and that's kind of where the IRS is going, isn't it? I mean, we're capitalizing almost everything now, when, at least if they ever finalize this thing and put it into practice, things that we used to not even think about capitalizing because of the dollar amount, we're going to have to. And so maybe that does have an impact. I don't know.
Yeah,
I think from a guideline it might, Mike, you know.
Well, actually, let me
tax
just bring another
purposes.
spin it back to tax credit properties. I've got all these
Yeah.
for-profit entities I own, and now when the IRS makes this move, and it will do it, you're going to be capitalizing stuff you haven't imagined you actually bought. So you're going to, at this point, you probably have a couple of choices. You're going to have to do it for those tax credit properties. Now you're managing two different fixed asset systems. Because they're going to, I mean, we haven't covered the rules here for some obvious reasons. That, you know, that first of all, it was delayed. But next year we might have to bring it back in, because that brings another question to me, like Mike brought up. Once you get into this thing, if you've got a lot of other tax credit development stuff, you're going to probably make the choice to change your cap policy, because you're not going to be able to manage two different things, and it's going to be life or death over in the tax credit side. So, you know, for different reasons, I would never have capitalized one-off carpet. In fact, I argue that turnover costs in a multifamily are expense no matter what. I don't care if they came from the for-profit side. I replace a door. HUD says I got to get it from the replacement reserve, but that doesn't mean I'm going to capitalize it. It's expense. You know, so I don't agree with them even at that level that multifamily recapitalizes carpet in a one-off thing. I just don't see that every time. It is now. Does anyone, TCWG, does any of you guys know what TCWG is? I was thinking I was missing a key phrase. Ray, save me.
Oh, those charged with governance.
I remember now where I saw it. I'm going, I've seen it somewhere. Those charged with governance. Do you have a comment here?
Yeah. The TCWG is now the new buzzword for boards, and since so many, have councils and boards and trustees and directors that, too many different names and labels to describe people who are in charge. So we call it now those charged with governance. Our best practices for evaluation and for small town PHAs. How do we find competent board members?
How about big time CH?
Yeah, even big time doesn't mean.
You know,
Because we audit a lot of small town Alabama, Georgia, and so you kind of get the picture. But in evaluating their competency and their ability to provide the proper oversight, you run into some challenges. And I was just curious on, yeah, just a few. And I've actually had a finding on one, but it's just, I struggle with it, and I was
Yeah.
just wondering what your thoughts
Sure.
are.
I mean, we had one board member that was, she was so blind that they had to put her hand on the check where to sign it. Much less thinking she could look at the invoice. There's no way. Now, on another agency, small agency, they literally had the state auditor on their board. That poor director is going to get away with anything, right? But it is a problem. This is an overarching problem, not for just housing authorities, but for all governments. We try to do things, training, ethics training, but they don't take the time to train, things of this nature. What you hope for is maybe that the city council, the mayor who's appointing these, will take a look at the composition of the board, maybe try to require one CPA or a finance individual, maybe an attorney on the board, maybe someone that has a construction management company. You start trying to set the board instead of letting the ED just pick the people they want on the board, right? Which sometimes turns into being the case, but it's an issue.
And I would reiterate what Ron's saying. I think many times the issue is it's the governing body over that PHA. It's the city, the county, or perhaps it's a state agency.
Manager or the mayor.
And many times what we see is if they're not really involved with that organization, then who drives the appointment of board members is the ED. And I don't want to beat up on EDs in here, but they're going to pick people typically that aren't going to challenge them, typically. And so sometimes the way we get around that is there has to be more pressure put on the city council or the mayor or whoever is the ultimate body that has to approve who gets appointed to that board. And they have to be more involved and make sure that those people are going to serve a good purpose of oversight for that board. And it usually raises its head when the PHA all of a sudden gets in a big problem with HUD, either fraud, embezzlement, or problems, and then all of a sudden, hits the fan, and now all of a sudden everybody's going, well, where did these people come from? Maybe we need to be more involved.
One more suggestion, Ray. If you have input at NARO or these other entities, and it comes down to training agendas, my answer to that is honestly, don't give them fluffy stuff to go to. I did a training in Utah. The housing authorities there tried to get me up to talk to the NARO, and we were going to try to get all those ED board members, commissioners over to that session about financial numbers, about those kind of responsibilities. And then at the same time, NARO gave them something about, it was some fluffy thing. Of course, where did they all go? I don't know. They didn't go to the fluffy thing either because they disappeared. And, they missed a great chance to hear about the financial side of this that the housing authorities were worried about. They want to communicate to their board members. They want to try to get them in a position. And that's some of these things are, you have to work really hard at it. There just aren't any easy answers. So even at that training level, scare them. I hate to say that, but, if you have more presentations about what's actually going on, if auditors did better presentation at board meetings about responsibilities and issues, they're probably, I don't know, maybe there's no hope for them at that stage. I don't know. But it's a long road. It didn't happen in one day, so it won't get fixed very soon either.
But just one thing that I've you know, part of it also is how do you run your board meetings a little bit? You know, again, we end up doing, I end up always seeing the worst housing authorities. So, you know, that's where, you know, I'm at half the time. But, you know, we were at a board meeting where they said, they came up to the board, the finance director, stack of paper like this, gave it to the board and said, there's your financial report. Are there any questions? Well, you know, that's not data. You know what I mean? So some of that is there's something on management side too, that how you present, how you summarize, how you provide facts actually helps them, you know, make those types of decisions.
And you know, unfortunately, when we're finance folks, I think someone else was up here, we tend to be so anal. We think the more pages and the more that we give people, boy, we're really doing a great job. And the reality is, the higher up the ladder we go, the more concise and to the point the data needs to be. Because those people are not going to get into the detail of it. Doesn't mean we shouldn't have it to respond to questions, but it needs to be aggregated so people can quickly, at that level, get a feel for what's going on in that agency, or any entity, really.
And especially for small PHAs, the monitoring, I mean, we understand there's not a monitoring system in place. Somewhat we can devise a monitoring report, a summary report listing the benchmarks. I mean, to me, I'm looking for communications, right? And so I have an ED come in and say, great, we're 90% leased. You say that, I mean, my kids come home, what do I think? Great, they made an A. Okay, from HUD, we're saying what? No, that's pretty bad. And so a lot of times taking these key indicators, leasing, you know what, anything above 96%, we're gonna make it green number. From 95 to 94, black. Anything under 94%, we're going to put in red ink. You set your parameters, what is important at that agency, and set them up in those colors. I guarantee you'll get the board members' attention with red ink.
But clearly, management has to be of the mentality that they want to have an informed board. I think that has to be said, because I think the reality is that's not always the case.
Yep.
2012, there was an offset, and basically HUD was mandated, that was mandated by the Congress, the amount, and basically what HUD did was go back and look at minimum balances for PHAs and then apply that offset to recoup or offset according to what the appropriations language required. This is a good question. I mean, our firm does a lot of this efficiency evaluation of voucher programs and other programs, and you always hate to throw these benchmarks out there because then people sort of see that as in stone. So I want to preface it by saying that it really depends on what you've assigned your housing specialist to do, and I'll use that terminology. Some of you may call them something else. But assuming that they're performing the normal eligibility and recertification and that type of thing, it's not uncommon that we should see between 400 and 600 vouchers per housing specialist. Now, if they're also doing inspection piece of it, then of course that number would need to be quite a bit lower. But that, again, I don't want to throw that as, you're always nervous about throwing out numbers because then people take that as sort of the sign, you know, the Bible, so to speak, but that's a guideline, somewhere around 400 to 600 vouchers, assuming that those housing specialists are performing the normal functions. So, you know, typically when we do efficiency and we look at the number of employees that PHAs have, we look at that ratio of employees to vouchers. Now, also, the more specialized vouchers they have, that require other special needs like VASH and some of these others, then of course that ratio might be a little different. Who's got the clicker? Oh, typically what we see is you're still going to record these costs of fraud collection down to the typical salary costs, benefit costs, other costs, just like you would any other. But what we're saying is, in order to document that, if you were to get challenged, you may need some other subsidiary ledger to support your costs. But there's nothing that requires you on your general ledger that says, okay, these are salaries related to fraud recovery versus non-fraud recovery. Would I recommend that you consider doing that? If you're doing if you have a large group of folks that are devoted to fraud recovery, it may make sense to track it at the general ledger level as opposed to a subsidiary ledger that you're doing off in a spreadsheet. I mean, that to me is a call with regard to how you want to manage this and support it if you get challenged. But there's nothing that requires you to segregate those costs per se on the general ledger. You just have to be able to show HUD that you can support the amounts that were claimed against the cost of collection.
That was me.
Okay. Asked and answered. I can tell you, Kathy and I will see 600 to 700 multifamily submissions a year, and I don't see very many with unit-by-unit carpet replacement capitalizations. When I say not many, I'm talking in the tens and 20s. So, out of 700, there's a lot of carpet being replaced, and it's not getting capitalized.
No, but we do see a lot of small dollar items being capitalized.
Yeah, there's just not carpet. I don't know why they're capitalizing them, but I guess, from our side at multifamily, we're now getting much more concerned about the IRS rules. So, rental alignment. Okay, has anyone here talked to Stephanie in the last 6 weeks? Stephanie White? Here's what I know so far. Moving ahead, however, they will not be in REAC. They're going to use the HUD audit guide. They're going to change the audit policies. In fact, just 2 weeks ago, HUD put out a release, a housing notice saying they're going to eliminate audit requirements on certain entities under $500,000. They're talking Section 8 only entities, and they're eliminating the audit requirements that went along with those entities. So when they transferred the HAP contract from a previous owner to a new owner, the reason behind that is rental alignment, because as they're moving into rural housing now, they're going to eliminate smaller audits from those. And so that move was, and I haven't even, getting ready for the conference, we haven't even posted that notice yet, because it's really coming into play, seriously later this summer. But the point is, it's moving ahead. Here's what I know for sure. Not going to be in REAC in terms of reporting. They'll report separately in something else other than MINCS. And they are going to use the HUD audit guide as it sits today, and you'll be issuing major program opinion level reports on. So if you're a housing authority and you got a rural housing loans, those are now going to have separate things going on with those for multifamily. Now, currently, HUD doesn't make you audit those. They make you do an unaudited submission and wrap it into the PHA. We don't know what will happen with RD. But that's going to be the alignment proposal right now. I will have a better update from her in August, because she is coming to speak with me at Southwest Regional Housing down in Albuquerque. So she will be there then. I've contacted her a little bit, but haven't had a lot of feedback from some of the questions, but we do anticipate it going on and forward. (2013-6). One of my clients has interpreted this to mean that they can omit their RD project from their PHA submission. Please comment. Is it housing notice 13-16 or PIH notice? I'm not aware of that. It's the one that just came out. Okay, so was this your question? Okay. That's the housing notice I was just referring to a minute ago. Now, does that mean you can eliminate that from your PHA submission? No. It's going to be audited as part of the PHA. It's part of the single audit. It's got to be wrapped into there. But separate audits that would have occurred on Section 8 contracts were eliminated. And I've got to go back and read the notice, but my answer generally is it's going to be stuck in the single audit for the housing authority. It's one of the programs they own. and they're going to be reporting on it no matter what. So that notice to me when I first got it and read it quickly, I was like, maybe I was starting from the wrong perception in my mind of saying this is eliminating multifamily HUD audits that have RD project loans associated with them when HUD would have continued to require the audit in and of itself. But email me. Email me and I'll early next week I'll get it taken care of. We'll ignore the GASB 68 in part like they did with booking OPEB liabilities. Michigan did. Well, I guess the state law can do what they want. But if those auditors, I think, would have to issue different level financial statement opinions that would not be in accordance with GAAP. So the goal here is once GASB passed it, I think their intention was to have them report. And if you don't, I don't know what kind of exception you could get out of there other than, you know, at that size too, it may be a disclaimer for that size of a liability.
The OPEB is probably easier for them to hide too. I mean, they were never on the books before. You didn't have no disclosures about them before. So when Michigan just decided to skip those, it was kind of hard for someone to pick up. You already have a disclosure about your pension in there, so trying to skip it or not follow it's going to be a lot harder, I think. That one would be different.
Here's a question.
What I was getting at is this being reported on the audit reports, but the bonding agencies weren't taking it under consideration when the negative fund balances showed up.
That may continue. That's a choice rating agencies and funding agencies, banks could do to say, should we change our decision process based on reporting a liability that was already there and not reported? So they can choose to do that. They can ignore them and say that in our calculations we're going to eliminate pension liabilities. That's a choice. But they'll be on the balance sheet.
This is an interesting one. This has been popping its head up here recently, and we've had a fair number of clients that have been in this situation. And typically what we're finding is after HUD has completely done the closeout, in other words, they now have sent you the letter and they've said, okay, here's the final reconciliation, we are seeing that there are a fair number of PHAs that might have some residuals sitting in there. It's typically admin fees because HUD would have already done the reconciliation on HAP, but we are seeing that. We are basically recommending that once they receive those letters, that they move them over into the voucher program. I don't know Ron, what you're doing with your clients, but
We're typically moving them over to another fund, it's the state and local fund. However, we are listing all the cash and the equity as restricted for disaster programs only. They came out with that PIH notice several years back. I cannot quote you the PIH notice. If you need it, let me know. But the excess case management fees are indeed restricted for a specific purpose. It's not eliminated just because of the closeout of the program.
and that's why we're suggesting pushing it over to the voucher program, because it does have that restriction that it has to be used in relationship to disaster program in some way.
So for that one, if you're reconciling your voucher equity, would you count that as revenue in the current year? You're trying to get to your restricted net asset.
Yeah, we typically have just shown it, and Ron, you could say differently, we show it as just a transfer from one fund to another because it's already been recognized. So we're just transferring it over, so to speak.
Yeah, typically we use the equity transfer line because we're shutting down the program completely.
And some of you have the same, issue in your mod rehab programs where you might have, after HUD's done the final closeout for your mod rehab programs, where maybe they're not getting renewed and you have some, unrestricted net assets sitting there. Those are typically, transfers of equity over.
I think it's supposed to be reported.
Let's put it this way. I have no reason right now to state that it would be anything other than expenditure on your CFA. I'd have to go back if you want to communicate with me. I think we can find that out through the regulations, but I'm 90% certain that that's got to be in there. You know, I can't find any particular reason for it not to be included with the PHA. Now, I know you're saying it's more of a vendor relationship, but who's responsible for determining all the factors and reporting that? I'll bet you dollars to donuts we end up at the PHA. So email me. That's.
The only other thing I wanted to add there that kind of, I'm sorry, that I guess confused us a little bit, is that when you go up to the CFDA website and you look up the CFDA
Oh, yes.
number, it says it's a type C, and it also says
It's exempt from A133.
yeah, that
Yeah.
it's exempt from A133.
Most of those comments are all like somebody smoking a joint and when they wrote those things because they're not true.
Okay.
Okay, so I'm being very frank about that. I'm joking a little bit about the point, but there are
Yeah,
tons
no,
of
we're
in
just
multifamily that are saying that. Oh, we're exempt from A133. Well, why the heck is that? Who had the right to do that? And it's not true. When you go back to the program side at HUD or anything, they're going, I don't know who wrote that at OMB or whoever, but that's not true. They all have to be audited. And I would say go back to the regulatory agreement that started the mess to begin with, and by in there it'll say we need this at 90 days. Or, 9 months at the end of A133. Now, Chris, I have one more question for you that I put on here. RAD.
What about it?
I've already had several questions about training for RAD. Give me an update on RAD.
Update on RAD. Well, we know there's a PIH notice coming through. It's been stuck in clearance for a little bit, and that itself is going to, I think, answer a lot of the questions. It's going to set some new dates, and so it's a pretty big, thick notice. There is actually going to be some training on RAD this summer, but it's not technical in nature. It's really geared for how a housing authority could roll this out. What do they need to do? What are your residents? What rights do they have? So it's not necessarily financial or accounting based on how to do your application. Just more of what is this? How does this work? If you wanted to start it, and the plan is right now. I think there's supposed to be 2 sessions before the end of August, is what they're shooting for. But again, I think RAD overall is moving a little bit slower than they would want.
Just continue this conversation that we had with you about multifamily stuff, right? Go ahead.
No, I was finished. Go ahead. But ask me a question because I'm not sure. I was done.
Done. Thank you. That's it.
Who's doing the RAD training that you were just talking about?
They're thinking right now what they would like is they would like to actually have it done by HUD staff, and they would like to have some of the PHAs who've already applied and won, kind of give some best practices. Yep. I mean, I haven't seen what's actually in the training, so it's hard to say what it's going to be. But again, it's the idea. It's not going to be. The idea is it's not going to be really technical in nature. It's the idea of explaining what RAD is, how it works, the big pieces, so people understand milestones, residents' rights. So from that standpoint, yeah, I mean, I think, that's the goal, and it sounds like something like the board or executive directors or, or senior management who are trying to think about this, should attend. And if you can't make the trainings, because I think they're supposed to be, both of them are supposed to be in DC, they're going to start, it's the idea that they're also going to do a series of webcasts, and they're getting some material that can go out to in PDFs and stuff on their website. But my guess is you're looking, late summer.
Has this even gone through Congress yet? Has the funding been approved by Congress yet?
Oh, yeah, I mean, this was what they had, 60,000 units, wasn't that what the RAD mark was? It was 60,000 units could convert. The first round of applicants was due, I don't know, probably about 9 months ago, it seems already, and they're already looking at the second round of applicants, and they're handing out awards.